Well, good morning. This is your Entrepreneur News Minute with a focus on AI and venture capital investment. This is Phil Greenwood, University of Wisconsin, Madison, Wisconsin School of Business, the Weinert Center for Entrepreneurship, emeritus/retired. Article in the Wall Street Journal from a few days ago talking about how much the investments in AI are booming from a venture capital standpoint, but the profits from those firms haven't started occurring. You're seeing revenue with Perplexity and OpenAI and people like that, but they're losing an incredible amount of money, which of course is part of the problem. So from a VC perspective, if a company is not making profits and you can get dividends and things like that, your next best bet is you want an exit after the 5 to 7 years, and you definitely want that IPO or hopefully a sale, merger, acquisition, whatever. What the article highlights is how the investments are really high, profits aren't there, but it states how last year venture firms, or in this past year, venture firms invested over $60 billion, but only returned $26 billion to their investors. So there's a big disconnect. They brought in 60 bill, only returned 26 billion, so 34 billion is either lost or still invested in the companies. Part of what the article attributes this to is, of course, the AI startups and how much money they're taking, not just the startups, but growth firms in the growth phases and their valuations. So as long as that growth and valuation increase keeps going up, it'll keep attracting the investments. For instance, OpenAI, still private, 166 billion. Musk's XAI, really just several months ago, 24 billion. Going to look at financing to try to at a valuation of 40 billion. And Perplexity is on the market to look for money that would raise its valuation by 3 times, 3 billion to 9 billion. So incredible growth. Firms are not profitable, so the profits aren't driving the thing. It's just the interest in the long-term growth potential of these firms. An interesting highlight in the article is that they cited a study where 1,400 startups are currently valued at $1 billion or more. The old unicorn status, whether they were AI or non-AI. So what does this all mean? Well, partly, we got to worry about valuations because, if something kind of pops or explodes or there's some kind of bubble, valuations can come down real quick. Investments can dry up real quick and makes life very difficult for the VC-backed industry. Second thing the article really noted beyond the valuations was there's just not a exit. A lot of exits going on in the tech AI space. Partly the IPO market isn't what it used to be. It's frozen. VC funds have incredible amounts of funding that they can keep these companies private for much longer into the, rounds A through D, E, F, G, H, I, whatever. But also due to regulation, there's just not a lot of M&A activity, mergers and acquisitions. And the thought is that they're just waiting until the new administration comes in and they'll really relax the regulation and the antitrust issues that have been raised by the current administration. Whether that happens or not, we'll see. So if deregulation occurs, if things continue, there's not a bubble that bursts, you'll probably see the IPO market pick up. And of course the M&A, where the firms will start buying each other, especially the ones that have technology but can't survive anymore, or the investors need an exit, and things will be hunky-dory. So there's your Entrepreneur News Minute for November 19th. Have a great day.